Welcome, finance aficionados. Are you sabotaging your investment success with bad habits? It's a question we often overlook in our pursuit of financial growth. In our journey towards building wealth, we sometimes forget that habits, good or bad, can significantly shape the outcome. In this video, we're going to delve into the top 5 bad investment habits that could be hindering your financial success. Today, we're uncovering these pitfalls and providing tips on how to break them. Get ready to transform your financial strategy. First, let's tackle overconfidence. This is a classic pitfall where a few early victories make investors feel like they're the masters of the universe. But here's the kicker. Overconfidence can blind us to potential risks and pitfalls, leading to rash decisions and ultimately financial fallout. So how do we keep our feet on the ground? The solution is continuous learning. Knowledge is your best defense against overconfidence. Keep yourself updated with market trends, new investment strategies, and economic indicators. Don't shy away from seeking professional advice. Financial advisors can provide a valuable second opinion and help you spot any blind spots. Remember, the investment landscape is ever-changing. Stay informed about market changes, consult with financial advisors, and never stop questioning your decisions. Now, impatience. It's a familiar feeling, isn't it? The itch to see quick results, the restlessness when things don't move at the speed we desire. But let's face it, in the world of investing, impatience is a dangerous companion. It nudges us towards rash decisions, towards looking for quick wins, which more often than not end in losses. It's a harsh truth that impulsive decisions seldom lead to success in the long run. Instead, patience is the name of the game. It's more than just a virtue in investing, it's an absolute necessity. You see, the most successful investments are like fine wine. They take time to mature. Remember, Rome wasn't built in a day, and neither will your investment portfolio be. Over-leveraging is our third habit. It can be a tempting strategy, allowing you to buy more assets than your cash reserves would normally permit. But here's the catch. While leveraging can magnify your returns, it can also magnify your losses. It's like swinging on a financial pendulum. The higher you swing towards potential profits, the further you could potentially fall into losses. So how do we manage this? The key is to assess your risk tolerance. Know your boundaries. Understand what level of loss you can comfortably withstand. Then use leveraging sparingly within those boundaries. And always have a plan. A plan for when things go south, a plan to manage potential losses. Remember, in the world of investing, it's better to be safe than sorry. Use leveraging cautiously and always have a plan to manage potential losses. Fourth is investing blindly. This is the financial equivalent of walking a tightrope with a blindfold on. You may get lucky and make it to the other side, but the chances of a misstep are high. Investing blindly happens when you jump on a bandwagon without understanding what you're actually investing in. It's like buying a ticket for a flight without knowing the destination. You wouldn't do that, right? So why do it with your hard-earned money? The antidote to blind investing is research. Dive deep into the business models of companies you're considering, evaluate market conditions, and understand the long-term prospects. Always research before investing. Understand the business models, market conditions, and long-term prospects of your investments. Finally, lack of diversification. This bad habit can be likened to putting all your eggs in one basket. If the basket falls, all eggs break. Similarly, if you pour all your capital into one asset class or market and it crashes, your entire investment can be wiped out. On the contrary, diversification is your financial safety net. It means spreading your investments across various asset classes, industries, and even geographical regions. This strategy reduces the risk of catastrophic losses, as poor performance in one area could be offset by strong performance in another. It's about creating a balanced portfolio that can withstand market fluctuations and deliver steady returns over time. This way, if one investment performs poorly, others can balance it out. Let's look at some real-life examples. Remember the dot-com bubble of the late 90s? Many investors, driven by overconfidence, continued to pour money into internet-based companies, ignoring the risks. When the bubble burst, they were left with significant losses. On the other hand, consider the financial crisis of 2008. Many investors who diversified their portfolios across various asset classes and industries managed to limit their losses. Some even saw gains in areas like bonds and commodities while the stock market plummeted. These instances clearly demonstrate how bad habits can lead to dramatic losses. but good habits can help protect and even grow your investments. These stories underscore the importance of avoiding these habits. To sum up, successful investing requires proactive steps. It's about constantly learning to curb overconfidence, practicing patience for long-term gains, using leverage wisely to manage risk, and never investing blindly. Do your research, understand your investments thoroughly, and remember, diversification is your financial safety net. It's a strategy that spreads risk and can potentially lead to more stable returns. Don't let bad habits derail your financial journey. Adopt these practices to safeguard and grow your investments. Transform your investment journey by breaking free from these bad habits. It's about continuous learning, patience, wise leveraging, thorough research, and diversification. Let's put a full stop to these pitfalls and march towards a more secure financial future. For more insightful investment strategies, don't forget to subscribe and share your thoughts in the comments below.